Hey everyone, thanks for joining us for this interview. I got a really special guest for you today. If you're coming from one of my Udemy courses, you know that the financial modeling for startups course, we talk about how to estimate and come up with sort of how much capital you need to get your business started and running. But we didn't really talk about where do you get that capital. So today, my special guest is Warren Shaeffer. He is an experienced serial entrepreneur. He's started and successfully exited from uh, a series of startups, and he's working on a new one right now. Altogether, I think if I didn't get it wrong, I think he's raised around 10 million in seed and venture funding for his startups. He's raised from TechStars, um, Upfront Ventures, and most recently a seed round that was led by Andreessen Horowitz. So, if you want to know how to raise funding for your next startup, you're going to learn a lot today. All right, Warren. Uh, before we get into the questions, maybe you could let the viewers know a little bit about some of the projects you worked on before and what you're working on today.
Yeah, first off, Simon, thanks for chatting with me. Really excited to share what I've learned over the years around startups and raising money for startups. I worked in finance before I left the safe haven to pursue kind of the risky startup world. And
Mhm.
one thing I want to mention is that I think for a lot of young people, risk is subjective, right? So what's safe for one person is actually unsafe for another person. And in terms of what I did after finance, I worked at an accelerator called Mucker Lab out of Los Angeles. I teamed up with my current co-founder, Alex, and we co-ran a company called Social Engine. We made software for people and companies to create their own social networks. And that company was largely bootstrapped, had over 15,000 paying customers, including some big corporates like MasterCard and Apple, and even NASA built a community using Social Engine software. And we got some offers to
Wow.
sell the company and sold it in 2014 to a marketing agency. And that company and product still lives on. Alex and I then went on to build VidMe, which we scaled to over 25 million monthly users. It was a user generated video platform. And we were one of the first platforms to introduce direct to creator tipping and monetization. And now we're working on Knowable, which is an audio first education platform, and excited to tell you more about it.
Yeah, awesome. Thanks for the rundown, and we can talk about the cool things that you guys are doing at Knowable next. So I guess right now, a lot of the students that we get, they're really kind of at the very early stages. They've just started and are bootstrapping an idea, or they're they have an idea, they're wanting to dive in, and then we kind of get the sense that a lot of them are just kind of jumping ahead about how to raise money, when some of them haven't really thought through their ideas. What are your advice? What would be some advice you have for founders who are just starting, but maybe you know, they're working towards raising funding at some point in the future?
Yeah, raising investor money isn't a prerequisite for every company. And I think the most important thing to do is to really educate yourself about what running a venture business involves versus what a bootstrap business involves. And really, there are pros and cons. And there are some businesses that are great fits for raising venture capital. And then there are other businesses that are great fits for being bootstrapped. So, really, when you raise capital, you're trading ownership in your business for near term liquidity for your business to run. So I think my first piece of advice is get smart on what it means to run a venture business versus a bootstrap business.
Hmm. And and do you think like kind of what it takes to raise funding? If once you kind of decide, hey, the venture that I'm looking at is more suited for venture funding. Um, do you think how the VCs are looking at raising funding is different now today, given kind of what's going on, versus say even just
Yeah.
six
So
months
if you
ago?
know that you want to raise venture funding and you think you've got a business or an idea that is a good fit for a venture investor, I do think times are different. Times have changed. So obviously we're recording this during the COVID pandemic, and while some of the shelter in place orders are being lifted, it's harder to build relationships. And a lot of what investors are doing is they're building a relationship. They're making investment, not just in the idea and the business, but ultimately in the person. So you'll have to kind of adapt to convincing an investor or a group of investors that you are worth funding over Zoom, most likely. And I think it is happening, but it's probably going to take longer, and the market is a little bit less competitive and frothy than it was 6 months ago. That said, venture funds have capital to deploy. They've already raised the capital, and their job is to invest. And some of the most successful companies were started in recession times. So I actually think this is a great time for investors are actively looking for great companies that they can invest in. And in many ways, an investor's job is to look at what's changed in the world and how startups can outmaneuver bigger companies that are slower to adapt to those changes. So lots is changing. There's no shortage of problems in the world today, and startups are very well equipped to be agile and solve those problems, which yields opportunity for founders and investors.
Yeah, that's really interesting. So, do you think some of the VCs are going to be kind of looking for entrepreneurs who are who are working on things that uniquely sort of can benefit or grow given the current circumstances? Kind of, it's not like something that would have just only worked in previous circumstances, but they're like kind of adjusting to the current
Yeah,
climate,
the
right?
world is dramatically different than it was a few months ago. And so that means that some businesses that used to be essential are no longer essential. And there's an opportunity for new
Yeah,
businesses to become essential, right? So in the same way that there's essential workers,
yeah,
I think there's a new opportunity to make essential businesses, right? So skating, there's kind of this old cliche, right, of skate to where the puck is going, not where the puck is today. And
yeah,
that's so much
yeah,
of what a
yeah, yeah.
founder's job is. To identify a problem that you think needs solving and paint a picture of how your solution is going to be in demand for demanded by a lot of people.
Yeah, no, great point. So another thing that a lot of the entrepreneurs have questions about is sort of balancing what might be more available or easier, quote unquote, easier access capital, like friends and family, or potentially like some angels, kind of just immediate outside their network. How would you think about looking at those sources versus, say, like true venture funding? Could you, I guess, walk us through how you would think about that, or which kinds of startups or maybe founders would be a better fit for one or
Yeah,
the other?
this really goes back to that first principle of understanding the whole spectrum of company funding, right? So on one side, there's bootstrap, where you take no outside capital, you retain 100% of the ownership if you're a sole founder, and you're paying for the operations of the business through revenue that you're generating by getting customers. Those businesses often don't scale as quickly as a venture-backed business. So on the other end of the spectrum, you've got a venture-backed business, and if a large VC is investing in your company, they're looking for an outcome that can basically return their fund. So if they've got a $500 million fund, they're hoping that you're going to yield $500 million of profit at least, so that they can totally pay back their investors and then make more money on top of that from all their other investments. So, and then within that spectrum, you have things like angel investors, or friends and family first, then angel investors, smaller seed funds. And so, really, the size of the fund, the amount of capital that a person has, usually determines the size of the outcome that they would be happy you having, right? So, if
Mm,
you raise money from a friend and you double their money in 6 months, they're probably going to be really happy with you. That's not necessarily the same for a large venture fund. As crazy as that sounds, they're looking
yeah.
for those really outsized returns, the kind of Facebook or Amazon type businesses.
I think that's a really simple metric for the entrepreneurs to remember. Um, cool. A lot of the questions we get are kind of centered on how do we pitch, or say, how do we
Yeah,
successfully pitch an investor to get funding, but there aren't a lot of questions about when an entrepreneur should think about pitching or trying to go raise funding, sort of the timing of it. Could you speak a little bit about that? When should an entrepreneur, at what point should they think about, like, this is the right time to go
yeah.
pitch?
The best time to talk to an investor is when you don't need capital, right? Because then you have the leverage
Yeah.
in the situation. And so really a lot of investors look to build relationships with entrepreneurs. And so in many ways, fundraising begins before the pitch meeting. I actually think the most important thing you can do as an entrepreneur is to make friends with other entrepreneurs, because those are the gatekeepers to the best introductions for an investor. And oftentimes, when you think about building social capital, a lot of people try to build social capital with somebody who's already famous. If you're really thinking long term, what you want to do is you want to invest in people who aren't yet famous, right? Become true, genuine friends, add value to your network, because over time, the people that you know, at least some of them, will start to accrete social and political capital. And you want to basically know them for a long period of time so that then they can make an introduction for you and say, hey, meet my friend Symon. Maybe his business isn't a roaring success yet, but I've known Symon for 5 years and he has always been helpful and responsive and he's been working on this idea and I know him. You should talk with him, right? So one is invest in your network and your relationships. Two, in terms of the timing of when to raise, it really is a function of need and ability, right? So if you
Mm-hmm.
if you have a product that's in market and people are throwing money at you, that's a good sign that you've got something that works and it might be a good candidate for a venture backed business. If you just have an idea and have never scaled a product, you're going to want to spend some time really validating the idea, really getting familiar with how VCs think, what they're going to want to see, and how they're going to evaluate you.
Mm. Yeah. Yeah, and another common question we get is, if we're looking, if an entrepreneur is thinking about venture funding, that they think that they have to sort of locate geographically at the, you know, venture epicenters of like the Bay Area, New York, and LA. What are your thoughts on that? Is the scene kind of changing and becoming more sort of spread out, or for the best chances of getting funded with a fundable idea, should the entrepreneurs consider relocating to one of these sort of
The short
hotspots?
answer is that it depends, right? So if you are in the early stage of your career and are able to go and move and be in an epicenter around other people who are working in scalable venture ideas, then great. Then it's probably a good use of your time. If you're in an area that's outside of SF or New York or LA or some of these other hubs, you're just going to have a harder time building your network. But that doesn't mean that you're not a
Yeah.
fundable venture. And so really that just means though that you'll have to have more proof that what you're doing is working, right? And that uh,
Mm.
investors are in the business of managing risk, right? So they want to take as little risk as possible to have the greatest reward as possible. So the more that you can de-risk by being a known quantity, by being introduced by somebody who the investor knows or has known for a long time, by having a product that people are raving about and paying for, by having built a company before, the more things that you can do to de-risk, the greater your chances are that an investor is going to be interested in investing in you. And so geography is definitely not a prerequisite. And many investors are saying, don't build a company in San Francisco because rents are extremely high, cash burn is extremely high, the competition for talent is so high that actually early stage startups may be at a disadvantage now.
Because then they kind of have to put in a lot more work, a lot more effort, and raise a lot more just to sort of get to the same point, compared to if they were locating somewhere else that had cheaper resources and more easier talent pool to draw
Yeah,
from
exactly.
potentially.
And also there's groupthink in some of these hubs too. And so if you are a founder
Mm.
based outside of one of these hubs, you might have insights to a unique problem that somebody in San Francisco doesn't. So that's another thing to consider
Uh,
as well.
cool. Okay, so these are kind of like this flip side question. Like, what would you say are like, sort of like the top one or two mistakes you see sort of first time entrepreneurs looking to raise that they make that basically screams red flag and immediately gets a no? And then what is like the opposite, the one or two things that kind of gets it right and helps them kind of increase their chances of getting funded?
There's this cliche among founders that raising capital is kind of like dating. And one of the big no-nos of dating, at least I think I've been married for a while, but at least it used to be that you don't want to seem too desperate, right? So if you're coming across as really desperate, then somebody might look at you and think, what's wrong with this person, right? So that's important. Two, kind of a big uh, fallacy that a lot of founders make is they're too precious about their idea and they're not willing to share their idea. And so they might ask an investor to sign an NDA, a non-disclosure agreement. And that's just a red flag that you're not in the milieu of the way an investor thinks today, right? Because the belief right now is an investor's reputation matters so much that they wouldn't steal your idea to make a short-term buck at the risk of their long-term reputation. So NDA, seeming
Yeah.
desperate, asking for an NDA, and being too protective of your idea are kind of signs of weakness. In terms of what you can do really well to increase your chances, the best thing you can do is
Yeah.
be solving a problem that people want to pay for, right? That's the best, and that's the goal of your business, right? Raising funding isn't the end goal. Raising funding is a necessary means, oftentimes, to build a scalable business quickly. So aside from finding a problem that you really care about and are passionate about, and having a product in market, something else that you can do is really just checking boxes of de-risk, right? Of making it seem like even if this is your first rodeo, you've got something about you that an investor wants to believe in, right? So demonstrations of grit or perseverance or past success or thinking outside of the box, anything that you can do to demonstrate that you're investable is really important and beneficial.
Mm, yeah. And would you say, like, in terms of like sort of getting traction, then that getting paying customers would be much more valuable than, say, like getting users who signed up, right? And then I guess at another level than just getting like some other vote of interest and sort of different degrees of proof of concept and
Yeah, so you're
traction.
touching upon something interesting, which is another thing that you can do really well is understand that each investor is different. They don't all think alike. So some investors will really want to see that you've got paying customers, that you're profitable, that your burn is low. And those tend to be kind of the smaller investors, the friends and family, the angel investors who have a lower risk tolerance.
Hmm.
The uh, bigger funds who have kind of are looking more for that binary outcome, right? Of can this company return my fund?
Mm,
They're going to care a lot more about growth potential, right? And less about this short-term
yeah.
profitability and more about, do you have an ability to build a large, scalable, defensible business? So Facebook, Amazon, Pinterest, some of the most valuable companies lost money for a really long time, but today are extremely valuable long-term. So it's not an easy answer to say, oh, I've got these customers and I'm making $10,000 of revenue a month, like I should be fundable, versus this other company that might be losing hundreds of thousands of dollars a month, but may actually be long-term more valuable. So ultimately, you need to learn about how investors think. And
Yeah.
when you are raising money for your company, you really need to think of it like a sales process, right? And the best way to sell somebody on your product is to know what they want, to understand your customer. You're
Yep.
selling shares in your business, and that's the product that you're selling. And you need to understand how they would value those shares, right? They might be the kind of investor who wants a sure thing investment and is looking to make a 10% return, or they might be the kind of big VC who's looking more for that next Amazon, next Facebook, next Zoom type investment.
Yeah. Now, online, we see all these like, oh, this pitch deck. This is a deck that raised 10 million. This is a deck that raised 20 million. It kind of gives the impression that the pitch deck is the most important document of any startup. How important is the pitch deck really, and sort of what are a few key things that founders need to do to sort of get their pitch deck right?
Yeah. So I think the deck is not the thing that gets somebody funded. It's kind of like just proof that you know how to make a deck and that you can think in a framework. It's also really helpful for the founder to articulate what's the problem that you're solving, what's your solution, why does now matter, how are you going to make money, right? That you've thought through these very basic fundamentals of a business. But ultimately, so much of it just comes down to the story. The best pitches that I've had are ones where we didn't even look at the deck, where we just talked about here's what's happening in the world today. Here's this key insight that we have. Here's why we're uniquely qualified to offer a solution to a huge problem in the market. So
Mm.
creating rapport, right? And
Yeah.
again, this kind of goes like into the dating metaphor. You don't want to be totally scripted. You want it to feel like there's a fit and there's a conversation happening. The faster you can make a meeting turn into a conversation, the more likely that it is going to be enjoyable and successful for both you and your counterparty.
Yeah, because you're going to be
Right?
working with them, right? So like maybe a VC group might sound great on paper as a fit for your startup, but maybe the sort of their style or your style just isn't going to fit with how they want to manage their
Totally.
portfolio
And Simon,
companies.
another thing too that I think a lot of founders make this mistake of thinking that investors know all the answers. Investors are see a lot of businesses, and so they have good input, and but that doesn't mean that they know whether your business is going to succeed or fail. So sometimes an investor might pass. That doesn't mean definitively that you have a bad idea or that your business cannot be successful. It just means that it wasn't a right fit for that investor.
Hmm. And just because they invested doesn't mean that
Right.
it's going to work either. They could always they could be
100%.
wrong too.
That's right.
um, Well, there's a lot more interest recently, or a lot of kind of incubators and accelerators that kind of spring up. What are your thoughts on entrepreneurs looking at those programs instead of, say, going directly to like a bigger VC?
Yeah, I'm a fan of accelerators. I think that they are basically grad school for first time founders. I went through an accelerator, I went through Mucker Lab in LA. And what I mentioned earlier in our conversation about building a network of fellow entrepreneurs, I think it's so important for your long-term network value, for your sanity, for your friendship. It's really, in my mind, a solid first step for most first-time founders. There are exceptions. There are people who make a product and just feel like the equity trade-off isn't worth it. Um,
Yeah.
but I'd say if you're a first-time founder, especially if you're outside of a tech hub and you don't have a big network, it's a great way to meet fellow entrepreneurs and to meet mentors and advisors who can help you avoid some of the common pitfalls of entrepreneurship. Yeah,
Oh, great. And like with talking to investors, let's say you get a term sheet back. Um, how would you sort of for inexperienced founders and pitching them, how would they know that what they're looking at is a good
yeah,
or bad deal? Is there like things that they specifically could say like, "Oh, this looks good,"
right.
or "This
So
looks
you get
bad"?
this document, and it's really exciting. You're like, oh, I got a term sheet, which is what your kind of goal is when you're going through the fundraising process. And I remember getting this term sheet from a foreign investor and thinking like, oh, this is so exciting. We get this large Chinese company is making us this great investment, and it's all legalese, right? Like liquidation preference, term, what's the pre-money value, the post-money valuation, all these terms that if you're a first-time founder, you're not used to, or if you're not a lawyer. And so the best thing to do is hire a lawyer who works in VC-backed deals. You don't want to hire a lawyer who like also handles your grandmother's estate. That's just not the caliber of lawyer that you want. You want somebody who works with venture firms and works with VC-backed founders, and almost exclusively, because they're going to know what's standard and what's not
Oh,
standard. So we took that term sheet. We're like, hey, we got this term sheet, and we sent it to our lawyer who worked at Cooley. And the way I would suggest you frame it is on a scale of 1 to 10, 10 being the most founder friendly and 1 being the least. Where does this term sheet rank, right? And a lawyer who sees maybe 1,000 term sheets plus a year is going to be the best guidepost. Also again, talking to founder friends, comparing notes.
yeah.
There's some confidentiality clauses in term sheets, but you can share it with your lawyer, and that is protected,
Mm,
and,
yeah.
and advisors of the company to get advice. So yeah, don't sign the first term
Yeah.
sheet that you get.
Yeah. And don't would you also advise sort of a related one, don't accept it as is? It's almost like they're always going to try to give you something that is less than what they're willing to offer, or do you find that, that's kind of different depending on the
Yeah,
investor?
look, it really depends on the nature of your discussion, but the best thing you can do is get multiple offers. So right, because then you have the best position to legitimately negotiate, which is to say, hey, you're my favorite partner, but your terms are not as good as this other, and again, you have to be careful about violating confidentiality, but you can signal that, I'm sorry, your offer is not competitive, right? And that will give you an opportunity to say, here's what I think would be competitive. And so there are
Hmm.
graceful and tactful ways of negotiating. But generally, I think that it often doesn't hurt to negotiate. And even if the person rejects you,
Yeah.
you are coming at it from a position of confidence, and you're indicating that you value yourself, and your job as a founder is to protect and maximize
Right.
the economic value of your company. So I recommend,
So it's almost like
yeah,
a
of
signal.
course,
It's
and
almost
and
like
I
a
think
signal being
believe in
sent.
yourself,
Yeah.
right? And you're saying, hey, I appreciate the offer,
Hmm.
thank you. I This would be a lot easier for us to take if it was at, you know this level instead. And
Yep.
I hope we can make this happen.
Cool. I got two more questions. One of them is, it seems like more and more of these crowdfunding platforms are becoming available that makes it easier for certain types of startups to do sort of almost crowd fundraising, equity fundraising through crowdfunding. What are your thoughts on that? Is that something that like it could only fit for maybe a small group of startups? And what should a founder think about to consider it?
Yeah. So I'm not super familiar. I've never raised from kind of one of these broader crowd equity funds. They're pretty new, so I think the downside is that they're untested rather. I think another
Yeah.
downside too is when you disperse the investment, there are less people who care about your success. So a great uh, value add of having an investor is that you have somebody whose interests are aligned with yours. You are both equity owners in a business, and so they have a vested interest in seeing you succeed. Whereas when that interest gets dispersed over a large group of people, there's less responsibility from an investor to kind of be supportive, right? So often a great investor can help you do things like
Yeah.
recruit top talent, sanity check your strategy, and that's not something that I think one of the crowdfunding platforms will do. So from what I know, I would say
Yeah.
if you can get offers from both, and really do an apples to apples comparison, right?
Yeah, because you may sort of, I guess some founders are thinking like, well, I'm going to retain more control, but it may be hard to quantify sort of what you lose in terms of the connections and networks and sort of what the VC, a larger, well-known VC, in terms of what they can help you do in terms of growing your pie. You may keep a bigger percentage of the equity, but for a potentially much smaller
Right.
pie.
That's right.
And yeah, and then one last question. I think you're a father of two, right?
Yeah.
With two young kids. There are a lot of entrepreneurs who have dreams of becoming an entrepreneur, or want to do something entrepreneurial, but they have the impression that like, oh, I got to be like in my early 20s, I got to be able to pull all nighters all the
Yeah.
time, or they have this impression that it's only for the young and sort of the unshackled. But you just recently started raised seed funding for your
Yeah.
latest round with two young kids at home. How does that work? What would your advice be to other people in a
I'm,
similar
I'm really glad you
situation?
asked about that, because when I was younger, I thought there's no way that you can be both a father and a founder. You just can't make time for both, and you have to choose, and it's a trade off. And I spoke to another founder who has three kids, and what he said to me has resonated and been proven true after I had kids, which is, when you have kids, you become more efficient. You become more thoughtful with how you spend your time. So there's that quote that youth is wasted on the young, right? I think, yes, you can have a lot of energy and you can pull all nighters, but that doesn't necessarily mean you're being effective or you're being a great leader, right? Often that means you're just trying to micromanage everything and not empowering other people, or finding ways to be efficient with your time. So staying up all night and working 100-hour weeks, I'm skeptical of that kind of hustle porn mentality of it actually being effective. Oftentimes, what you see is
Yeah.
that person is spending 50 hours of their week reading TechCrunch, right, and trying to like see what other
Yeah.
startups are doing, and not actually really working. So I think the more you can be focused and present and very thoughtful with how you spend your time, and often that comes with experience and with age. There's a kind of a trade-off and a natural equilibrium that happens. So I think if you're a parent, you can definitely be a founder. A lot of parents have insights about markets that a younger founder doesn't have, right? A lot of young people come out of college and like, I'm going to make a restaurant app because that's what they know. They know about restaurants, right? Whereas if you're older, you've been through life, you've had to pay bills or get a mortgage or look after your kids. And so there are more problems that you are uniquely qualified to solve that makes you a very fundable and competent and effective leader.
So it kind of shifts your mindset to be looking at for sort of painkiller type of idea, business ideas where you're really solving a real pain point versus kind of like what they call vitamin business
Yeah, I think
ideas, right?
that's definitely a benefit
Yeah.
of being an older founder and having just more life experience.
Cool. Well, yeah, I think that's great advice. There's so many sort of these misconceptions about that. I'm glad you are able to clear that up. Um, Yeah, and sorry, I said two more questions, but I
Sure.
just thought of another one, and I think a lot of people are going to be very curious about this. Is from your standpoint, having worked with sort of a lot of VCs, like how do you think the VCs are going to kind of adjust their outlook in terms of, I guess, like, are there opportunities now that is going to get a lot more attention from VCs because of what's happening that maybe wouldn't have been on their radar? And like in terms of areas of opportunities or types of problems.
Definitely. I think the world is always changing, right? And that's why startups will always exist because they're able to move more quickly than a more established company to create solutions to emerging problems or emerging opportunities. So anything that's taking advantage of a cultural shift or a societal or technological shift will be interesting to a venture capitalist because it means there's a blue ocean of opportunity, right? So online learning is it's a category that Knowable is in, but it's actually being really benefited by coronavirus because people are not able to go to school. So they're looking for ways to replace in-person learning with online learning. So that trend we've seen be accelerated, and therefore there's more interest in investing in the space. Uh, there are things like food delivery, right? That's now a
Mhm.
business that has been accelerated, right? That was already a trend that was starting, but was accelerating. I also believe that anything in the creator economy, if you're helping somebody turn their knowledge into a business or their passion into a business online, that we'll see a lot more growth and investment in that area as well. But that's the beauty of entrepreneurship is there's a lot of people out there who are seeing problems. They look at those problems as opportunities, and they're going to create solutions to these emerging problems that the world is
Yeah.
not having a shortage of right now, unfortunately.
Yeah, yeah. No, thank you for that. And we covered so many topics related to fundraising, and I know we're just kind of scratching the surface of all this. Speaking of e-learning, I think this is a great segue into what you're working on with Knowable and the one of the courses that is the most popular course on the platform that kind of expands on all the topics we talked about, plus all the other important aspects of what a founder should really be keen on if they're serious about doing a startup venture. Could you tell us a little bit about
Yeah,
that?
yeah. Thanks for mentioning it. The course is called Launch a Startup, and it features. It's basically the course that my co-founder and I wish we had when we were starting out as entrepreneurs 10 years ago. So no BS, just the honest facts about what we've learned over our 10 years working in startups in terms of raising capital, in terms of coming up with ideas, in terms of validating ideas, etc. So it features Alexis Ohanian. He's basically the guru for the course. Alexis was the co-founder of Reddit, and he's now a managing partner at Initialize Capital, which is one of the top VC funds in the world. And he is the guide and talks with multiple people, including the host, who's a former editor at Wired magazine, and their converse. You'll hear from the founder of Everlane, the founder of Goat, which is the world's largest sneaker marketplace, a startup lawyer at Cooley, which is actually surprisingly one of the most interesting things that you'll hear. I mentioned the importance of having a lawyer. A great piece of advice that he shares is the best law firms will often work with founders for free if they get the right introduction to that founder, right? So you sometimes
Mhm.
by aiming really high, that's when you get the most value and bang for your buck, right? So I think that lesson
Wow.
is extremely valuable for first time founders. We also have a whole bunch of collateral. So there's a sample pitch deck, a sample co-founder agreement, And it's about 7 hours long, but it's audio first, so you don't have to stare at a screen. You can listen while you're doing the dishes, walking your dog, driving around. And I'm really proud of the course. It's we're actually going to give a discount to you and to your followers. So it's a
Sweet.
40% discount. It normally is $49. Um,
Oh, wow.
and yeah, I think we're gonna share a code that you can share with people.
Yeah, and for those of you who aren't familiar with Knowable, they have like the best app for consuming audio-based learning e-learning content. So highly recommend checking it out. They have a lot of other amazing courses from really awesome instructors, myself included, for one of the courses. Shameless plug here for the Airbnb course. But yeah, a lot of, one of the things that we get with so a lot of the courses, they're video based, and you kind of have to sit down and kind of attach yourself to your desktop or your laptop for that learning experience. And one of the great things about Knowable is everything's been redesigned, all the content's redesigned with the 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 student just going into the ears without visual aid. So all that content was purposely designed for that kind of learning experience.
Yeah, so we're an audio first company, but we're actually not audio only. So we do have PDFs and lesson notes that you can read if you want to
Mhm.
stare at a screen. But really, the idea is to fit learning into people's lives when they have downtime. And another cool feature that we have is you get an email after each lesson with notes of what you listened to and suggested further reading
Yeah.
and action items. I want to mention one other cool thing about the startup course I'm in is that we negotiated a deal with Amazon Web Services. So anyone who takes our course actually gets $1,000 in credits for AWS, which is basically, in our
Wow.
opinion, one of the best hosting services for
Yeah.
for running your website. So if you're serious about starting a company, I highly recommend the course, obviously, and it's a guaranteed return on investment if you're going to use Amazon.
Yeah, absolutely. Wow, the multiples
Yeah,
for their investment.
really proud of it.
Yeah. Well, awesome. Thank you so much, Warren, for taking the time to share your insights. And I think it's going to help out a lot of entrepreneurs and people who are thinking about fundraising and starting up something. Kind of dispel a lot of the myths for them, but also sharing about your Knowable and this amazing course by Alexis. And yeah, we'll hope people will go take the course, check out Knowable. If you haven't checked it out yet, go download the app, and we'll see
Thanks
you
so
again
much,
next
Simon.
time.
Really enjoyed it.